Okay, so let's get started. Today is halfway through of the course, so we are hitting the milestone. Today is lecture number 7. We have 12 lectures, 12 before receptions, and you are done with investment management. Then you probably will ask yourself, what did you learn? Of course, there are lots of things that I have been sharing with you. The problem is you may not have a chance to actually deploy what you learn to the simulation or to the real world. So that is actually one of the weakness about the course, because there are so many things that I want to share with you all at once, and I just don't have time to give you a summary. But if I take a step back, I think I should slow down a little bit. I give you a snapshot of what's going on. Next week, maybe on Monday or Tuesday night, I will have but I definitely will send you guys an email. I will send you an email regarding the market watch or any trading related questions or investment related questions. So you have to understand what is the meaning or what is the difference between trading and investing. So in terms of trading, it basically is just execution. For me, it's just execution, and you're aiming for extremely short-term investment. And for trading, it doesn't involve much of the analysis, and you basically hit the button and then just buy and follow your guts, and that's it. But for investing is something that you need to take into the news. You have to do your homework. So that will be something more in-depth, more intensive. That is investing. So that's two things. And of course, when you drill down to investing, then there are several things you need to take care of. The first thing is you have to understand what is return, what is risk. We talked about that. What is the measuring unit? How much money you make? Of course, that is important. But if you are making only $10,000 for decashing, that will be like that won't have a much of an impact. But $10,000, at least for me, that will be something, right? So that will be we have to use a standard unit to measure the return, which is in terms of percentage. And then once you get the percentage, then you know what is risk, and you probably have been asked in ICA 1, what is risk? Anything that is deviate from the target return, expected return, that is risk. So any answer that is actually close to that, you probably will get at least a partial credit. So that is the risk. But then why do you need to learn all this? Because if you don't understand the basic measure, then there's no way for me or for you even to proceed along what investment is. Once you have that, and then I explain to you, I show you, there are several tools for in a more general terms of how you can actually use different school of thoughts. So in Cantonese, 唔同派系. Let's say if you are playing the martial arts, you are fighting, then you have to choose. Are you going after karate, 空手道, or judo, 柔道, or taekwondo, 跆拳道, or MMF, which has no boundary? Then once you fix your school of thoughts, your style, then you pick and choose within the style what kind of tools you can choose in the investment. So this is actually what we have been doing. Of course, after the 3 school of thoughts, behavioral, technical, and also fundamental, then we are good. Then actually in the next few sessions, we are going to after for the this asset class. So right now you believe everything is about equity, stocks, but in fact there are actually more asset class than you can think of, and you wonder, hey, maybe I should do equity. But to be honest with you, if I have a second chance, in my career path, I probably will choose fixed income to begin with. that is actually another entire different monster and more stable, and it is better. Anyway, so this is the nutshell, but I will give you a summary towards the end of the entire course, and I will show you how you can incorporate everything you learn, every single lectures or sessions, how you can actually combine it and turn it out to your investment life. So this is the summary. And some of the students actually asked me, hey, can I get the previous lectures back? If you ask the school, they definitely will say, hey, it is not the obligation, there's no responsibility for the school to provide you any lecture videos. But I have been recording, as you know, ever since the day one. So you can check out the video link if you really want to spend another 2 hours to search for that. The good thing is that this particular video link is on YouTube, and you can actually translate that, transcript that into English. So that will be easier. I assume that my English is actually pronounce it correctly. So in this case, you will be able to read the transcript on YouTube, and you can actually play 2 times faster than what I need to say, than what I said, or you can actually make it slower to a certain speed at certain speed. So it is up to you. But the video link is right there. So on the far right-hand side, the video link, column I, if you click it, you'll see it. And you can drill down to any particular topics that you want to do a review. So another question is, I got a student asking me about our tutor and saying that, hey, ICA does not have. I was actually asking a question that is not on the slide, in the slide, but I was actually just talking on the lecture. No, the thing is, as I said, whatever I say in the lecture, probably is not the right or the formal source of questions in the IC or even in quiz. Whatever Eva says during the tutorial session, that is more important. So what I'm trying to say is tutorial sessions is far more important than the lecture section. She will go over pretty much everything that you need to be ready for all the ICs, including the quiz at the end. So remember the quiz. The quiz itself is 30 or 40%. I can't remember that, but it's a heavy-weighted segment. So you need to take care of that. And again, attend tutorial session. That will be far more important. And usually, just like ICA 1, ICA 2, the first hour will be just a review, and then the second hour will be the ICA. ICA. In the quiz itself, I mean, the ICA itself will be a very. It should be very. You can do that very quick, like half an hour. I don't think it will take a long time for you to do that. And I will adjust your skill set accordingly in the quiz. So let me know, give me any feedback, send me an email or tell Eva. If of course, if you want any particular style, but school has certain requirements. For instance, ICA cannot be a multiple choice question. So that's something that I cannot do. In the quiz, I think I can do some multiple choice question, but it won't help you that much. Trust me. From my experience, it seems like a qualitative question is better to give scores than multiple choice. Multiple choice is the one that will kill you like right away. You're either right or wrong. So that may not be that good. Anyway, so that's pretty much it. Let me follow up with what we left off from last time. So today I'm trying to cover three different PowerPoint slides. The first one is about maybe I take a step back. As I said, there are three different school of thoughts, right? The first one I showed that to you. Again, all these materials are out of the syllabus, but just for your information, technical analysis. The second one is the behavioral finance. Again, it's more like a psychological, emotional thinking, and that one is indeed cannot be quantified. So that's the problem. You can only explain a phenomenon, but you cannot quantify that and put that in the dollar sign into a stock valuation. So that is not that useful. The third one is the fundamental analysis, which we can actually drill down into a much deeper topic. For fundamental analysis, that is the science of finance. So if you talk about what finance is, some people said it's a social science. It is not a science. It is not an art. But for me, I think finance is a science. Finance can be a social science. Finance can also be an art. Because at the end, when I evaluate a stock, it is more like an art that what kind of painting, what kind of color I'm going to use, what type of paint I'm going to use. So that is more an art at the end. Within the fundamental analysis, the first thing you want to learn is the macro analysis, and then the industry analysis, and then at the end, the stock level analysis. So these three different levels, very important, because a lot of TV guest speakers, they just like stick to the technical analysis and 250 days moving average, and that's it. And even those famous speakers, they usually they will do something like this. But I hope one thing you learn is the fundamentals. That is the key to everything. So yes, last week we talked about the macros. The macros, it means the country, and we talked about government policy. So I'm going to have a very quick review with you. I'm not sure how many of you took macroeconomics before at university level. No one. It is not required. Macroeconomics not required. Damn. That's not good. Okay, let me put it this way. For economics, there are two types of economics. One is the microeconomics. So they focus on individuals' needs, or at most a company's need, and that's it. Macroeconomics, it's a higher level. Not that it's more advanced, but it studies the economy as a whole, the country as a whole, the world as a whole. That's called macroeconomics. So when I use the word macro, that means it's 宏觀. That is a much higher level. Not that it is at a more advanced level, but it is actually just trying to see from a different angle. But we are going to see the country. So there are two policies you just need to, well, not policy, but there are two things that you need to remember when you go after the macroeconomics. When you go after macroeconomics, all you need to do is to evaluate the government exercise tools, because the power that they have. Let's say you elect our chief executive. You elect President Biden, Obama, Trump, or President Xi, or Putin. All these government chief executive officer or the president is responsible to run the country, right? And in this case, they only have two major tools, two major powerful weapons that they can help to build the economy. Unlike the corporate, in corporate, it is a little bit different. But in a government, they only have like two major powers. The first major power tool is monetary policy, which is controlled by the central bank. So if you understand the Chinese government structure, the central bank is also running under the central government. So in this case, of course, like there won't be any independency here. In the United States, it is actually different. The central bank, which is the Federal Reserve Bank of a Federal Reserve Bank, we call it Fed Reserve or just the Fed, they are on their own. No one can affect their decision. The first president that actually challenged Fed all the time was actually President Trump. He was the only one that challenged the Fed chair and asking the Fed chair directly to lower the rates. And of course, he has his personal agenda. As I said, this guy is a fraud. He basically has a lot of outstanding debt, and 1% point of interest lower for the Fed, he can actually save hundreds of millions of US dollars every single year. In this case, why don't we do that? So this is the thing. But for him, that he was the first president in the United States that had so much impact to the Fed chair. Anyway, so you can see the monetary policy is controlled by the central bank. It works every single country. Why this is so important? Because for central bank, they will control the money supply, they will control the interest rate, and that will have a super fast effect to the economy. So when they sense the economy is running too fast, like the US inflation, then they're going to raise the rate. And then immediately you see the stock market just crash. Not like crash, but at least drop quite a bit. For last year, the market dropped 30%. In terms of the others, in terms of like on the other hand, back in 2020, when the COVID broke out in the first quarter of 2020, all the central banks around the world reduced the rates down to zero. It doesn't matter from 1%, 2%. Every one of them dropped down to zero, except China. China dropped the rate, but not that much. They still have like a 2 or 3%. But at that time, everyone drops to zero, and it gave the economy a power boost. So the entire economy just bounced back from that 30% drop, and within 3 or 4 months, you can see the stock market actually bounce back nicely. So if I so let's see back in 2020, right? You see, it wasn't nothing, and then when it broke out, SPX was 33.73, and then it dropped 1/3 down to like 23.04. That was actually within 1 month. 1 month, 30%. That is a quick drop. Within 1 month, all the banks in the world basically cut down to zero. Boost the economy, and then by August, so that's barely within 5 months, half a year, it bounced back beyond the original peak. It actually went even beyond. And how crazy that is? And it actually went up to like 47. So that is what, and then you probably ask, what happened here? In these two particular years, it was at a very, very low interest rate. I mean, again, it was zero before, and then raised to 1%, and then dropped back to zero. But how come the market reacts so fast? Because at that point, the government exercised the second power tool, which is the fiscal policy. The monetary policy help this particular rally. The fiscal policy helped the second. So what happened was these two things. The first one was controlled by the central bank. At central bank, but the second one was controlled by the government itself. So what happened with the government? Because for the government policy, they're able to create the government. They can create the government bank. They can spend a lot in infrastructure. They can reduce the taxes. They can even pay out coupons, pay out the monies to all the citizens, just like us. They gave $5,000 for the spending coupon, right? Cash. They give cash. In the United States, do you know how much they get per person? Close to $2,000 a month. A month. That was absolutely crazy. So let's say you have $2,000 a month, US dollar. What are you going to do? The first thing is, I'm not going to work. Well, first of all, some of them cannot go to work because it's COVID. The second of all is, if I get $2,000, that's good. I will spend the hell out of it. And remember, they are Americans. They don't have a concept of savings. Their saving rate is like one of the lowest in the entire world. They don't have concept of saving. So whatever they get, they will spend. And that's why you see that particular rate from March all the way to August. That is the power of fiscal policy. But in reality, I've never seen such a change from the fiscal policy that fast. So in this, usually when you have a government policy, they have the first two is actually coming from the fiscal policy. The last one is monetary policy, is from the central bank. So these are the powerful tools that they can have from the government. So fiscal policy, and then the monetary policy. So I'm not going to go into details what's going on, but basically the central banks controlling the money flow. The fiscal policy is about the government spending, taxes, and all kind of incentives. That would take some time to take effect in the economy. But the monetary policy, consider that as just an injection, a vaccination injection. Very, very quick, very powerful. You announce that, and then the stock market react right away. So monetary policy is very, very sensitive, and that's why this particular tool has to be controlled by some very, very intelligent, high integrity personnel. What I meant by high integrity means they really, really work for the people. They don't work for themselves. If they are selfish, then that will be bad. So think about this. Your great grandmaster is actually Janet Yellen. She was the Federal Reserve Chair at the time when President Trump was president. So she was the one to control the monetary policy, and she was the one to announce that, okay, well, let's I think she was the one straight down to zero. And then of course, President Trump doesn't like her. He didn't like her, and get her power up on board. And then she got kicked out. But she was a very nice lady, and she only wants to work for the economy, not any particular personal agenda. So very important. This one, monetary policy, is very, very powerful, very dangerous. So most of the people in the central bank, they are the PhDs, they are the professors. They study in like all those like great school. They will come from like a Stanford. They came from the MIT, Harvard, and they have spent decades of study in the thesis and studying how to make the best using the monetary policy. So those are really, really good people in the central bank. But when you look at the government side, the fiscal policy side, they are all politicians. So I cannot say any good or bad for them. But politicians against academic, you know which one is going to be doing good for the economy. So monetary policy usually will be decided by those academics, but very selflessness. But for the fiscal policy, that is by the government. So, and in terms of government, think about how the government can generate revenues from the taxes, from the parking ticket, or from the stock exchange. When you do the tradings, they will get a part from it, and that's it. That's the revenues. And the expenses, infrastructures, libraries, swimming pools, tunnels, bridges, those are the infrastructures, those are government budget. And of course, government budget including the $5,000 spending coupon. So they can actually do something like this, but that will create a huge deficit. So do you know what is our government doing? Mr. Paul Chen last week announced the financial budget. Do you know where he can find the revenues? Do you know Jockey Club, the largest club in Hong Kong? He said that, hey, every year, $25 billion. We are going to collect the $25 billion from the Jockey Club, like the ones who have the horse racing every twice a week. And he explained to the people, say, hey, 25 billion shouldn't be a large amount. You're on your own. I don't care how you make the money, but you just send me the check, $25 billion every year for the next 5 years. That's one way. What's that? Yes, secret tax. That's good. Raise the tax, and they collect from that. And then there's another one, the personal personal tax. There's a discount for that, but now he trimmed down the discount. So asking people to pay more taxes. So that is actually how the government fiscal policy trying to balance the budget. So if he keeps this really tight, that is actually hurting the economy more. So he has to be extremely careful. Does Hong Kong have a central bank? Anyone can answer. Hong Kong has a central bank. Very good. Hong Kong does not have a central bank. Hong Kong doesn't have any money supply. Yeah, you can have a Hong Kong dollar, right? But our currency system is pegged to the US dollar. This means that we are not allowed to freely print the money. We have to have the gold reserve enough so that we can print the money. And if the circulation out there, the Hong Kong dollar is dropping to a lowest level, what are they going to do? Then the HKMA will technically they will sell the bond. They will buy the bond from the market, and then in this case, the market will have more money in circulation. So this is how they pump the money. This is all about the monetary policy. So so I hope you guys understand what is the fiscal policy and monetary policy. So if you want to analyze an economy, then you have to take care of this fiscal policy and also monetary policy. Again, all I want you to understand is these two things are different, and you don't need to throw down like too much to do that. But of course, if you're able to absorb all the knowledge within, that will be good. And because once you understand the two major powerful tools, fiscal policy and monetary policy, then you can apply that to the business cycle. Because when you are in the business cycle, then you know exactly where and what kind of tools they are going to use. And with that, you are able to guess if the market is expanding or is on contracting. So the business cycle is the recurring pattern of recession and recovery. Peak is the, of course, the best. Trough is the bottom, the recession. Why this is important? The business cycle or the economy cycle, economic cycle. Why this is important? Because if you know where we are at along the business cycle line, So this particular line here. Then we know which industry will move faster. And what I meant by move faster means it will rise in terms of stock price, and which one will fall. So if I'm telling you that in advance, if US is going to have a recession, do you know which sector is going to get hit first? Technology, bank, healthcare. That will be the first one to get hit. Which one will have, you will see a protection, which means that you will get a less heat. Utilities, consumer staples, all these companies will have a sort of protection. So in this case, when you ask me like, okay, well, I got all the questions like the last couple of weeks. Give me a number, give me a number. Like everyone is forcing me to give me a number. Seriously, like it was yesterday. One of the magazine, the editor, asked me, okay, so you know that this Sunday we are going to have the two sessions, 兩會. Trust me, it took me a night and the entire team to study what the hell is 兩會, because I have no idea what that is. And I'm not shameful to tell you this, because it is actually in terms of this valuation, it is actually useless. But these guys, but a lot of readers, they said, hey, 兩會, the two in English is called the two sessions, will have an impact to the market. And you know what happened? Because 2 days ago, I was asking two of my analysts and try to run the analysis on the 兩會result in the last 8 years. Every single time after they announced the like all the policy change, and I asked them to check, to trace every single sector, their stock performance from the day one plus 1 week, 3 weeks, 1 month, 3 months, 6 months, 9 months, and then track the last 8 years. So what happened with the price after 2 sessions? And I was actually expecting that conclusion. It was so good. It was so predictive that the conclusion is that there's no conclusion, which means that the stock price will go whatever they want. It doesn't matter how presidency said, okay, well, this time I'm going to focus on the solar energy sector. The stock price for that solar energy sector will fall in 6 months. Does it matter? No, it doesn't matter. But all the editors asked me to give advance on this. I don't think 2 sessions will have any conclusions with the stock price change. But the editors didn't believe me, because he said, "Oh, you just give me the number." That was fair. On the other hand, whatever I said here is actually more reliable, because we can actually test it. We can actually see it. Let me. I'm probably will show you later on what is called a cyclical industries and defensive industries. Because when you are in a business cycle, when you are at peak or at trough, so when you're at a recession or the expansion, that actually varies. If you remember a few years ago, everyone was buying the technology sector. Why? Because we are at the peak at that time. We are going to the peak. So in this case, all these stocks that belongs to the cyclical industry will have a much faster growth in terms of stock price. And on the other hand, the defensive industries, utilities. So let's say number 6, the power, the power company, all the other ones like 中海油、中石油、中石化, all these guys will be in the defensive side. They will not have any price, sun price move or whatsoever. But back then, when we are going to the peak, the ATMX, that's the one that the people in Hong Kong talked about, right? Alibaba, Tencent, Meituan, and what is X? X is ATMX. What is it? Xiaomi. ATMX. It was doing really good. But then no, once you hit the peak, then it's going to going down the road, and when you're going down the road, then everyone is buying something different, and that will be let's say food producers, processors, pharmaceutical companies, even public utility, the one with low betas, high beta, with low beta. So you know what beta is? High beta, high volatility. So if I'm telling you US is going into recessions this year, Europe is going to be in recession this year. So let's say yesterday, Europe released a economic figure. Inflation is still a threat. Inflation is still a threat, and then suddenly like all the European indices grow. And yesterday, the data released in the US was not good, but then the market was actually staying flat. But you know what happened last Friday? Actually, this Monday, 4% up in the Hong Kong Hang Seng Index, right? 4% up. Why? Because the PMI, one of the economics indicator, that will give you the good to back up. So if you want to evaluate how good an economy is, then of course you have to understand the fiscal policy, monetary policy, and then understand what is the business cycle. And with that, there will be some indicators, some references that you can check if the economy is doing good or not. So all these economic indicators, they have different types: employment situation, spending situation, supply chain situation, and let's see if there's any growth rate, anything like that. But if I want to sum up the entire thing, how healthy an economy is, then we just need to remember CIGX: consumption, investment, government spending, and export, net export import. And in China, trust me, it took me a while to understand the terms. They said that 三隻腳, in China, they always 三個重點. And I was wondering why there's always like 3 points. And at the end, I finally understand that because in China, they put the government spending together with the consumption. So CG will be one group. And then they have the I separate in another group, and then X. So in China, they only have like three legs. And the difference is in the US, the consumption is actually quite high, close to 68 to 70%. But in China, the consumption, if I carve out the government part, is only 38%. This is why presidency in the past 10 years always said we need to bump up our internal consumption. 內需. I don't know how to pronounce it in I don't know how to pronounce it in Mandarin. But yes, and then I got asked the same question: which 內需股 I need to focus on? There is no such thing as internal consumption stock. But I always got asked, hey, if the 2 sessions is going to focus on the internal consumption, which stock should I buy? I said, can you link the 2 sessions, the 兩會, to 海底撈? I don't know. I don't think we can actually do that. Can you do that? Can you say, hey, 2 sessions is up, but because of the internal consumption, then I should buy more 海底撈? That's a 2 different thing. That's a totally different thing. If presidency said that, hey, each one of my citizens is going to get $200 coupon to go, they can only spend in 海底撈, then I can actually calculate that stock valuation. I can actually do that. But did he say something like that? No, he didn't say something like that. Will the government do something like that? Pump up $100 billion into the restaurant business? No way. Definitely no way. 2 sessions will announce, okay, well, this is the direction. Of course, the government is not going to spend a dime. It's not going to spend $1 into any particular business. You are on your own. But I'm just telling you that I will facilitate the process with you. But I'm not saying I will give you the money. So I don't understand why all the investors in Hong Kong in particular or in China, they will just bump up, hey, I need to buy some internal consumption stock. There is no cost effect relationship. That's a problem, right? But again, why will I say this? Because in the second, the third PowerPoint slide, I hope I can cover it today, will be about the company specific situation. So economic indicators. Let me go over this really quick. For the economic indicator, there are of course all the economic indicators will relate to CIGX to some extent. So some will focus on the C, some will focus on the G, and some will focus on I, and then they break it down into smaller components. And once you have smaller component, then the best way for you to do is, hey, I don't need to read all of them, right? That is correct. Because some of them will be like less impactful, some of them will be more influential. CPI, yes, very, very important. Let's say PMI, the ones that released from China, it was important. But the entire index up by 4%. And PPI, those are like the really, really important ones. Unemployment, those are important ones. So you check those. Those are all influential indicator. The people will classify from another angle. So for me, I will classify them as the important ones and not so important ones. And people will classify it into like in another category, which is called the leading indicator, and then the lagging indicator. So it is actually quite obvious. When I said leading indicator, it means that when they release something, when they release this data, it is actually reflecting the current situation in the economy, like right away. For the lagging indicator, like at the bottom, it means it is always reflecting something slow. It doesn't. So when you see a data change, probably it happened like 3 months ago. So it won't have much impact to the stock market or to the financial market. So people will focus more on the leading indicator. And then in the next few slides, we talked about the leading indicator and then the coincident indicator, C, so LEI and CEI. But the leading indicator, again, it's very, very sensitive to all the movement. So you can see the LEI will have a much movement during the recession time. And particular like nowadays, it's actually even moving faster. So if you go to investing.com, then you can see the economic economic calendar. So what happened today? They will list all the announcement today. So let's focus on the ones that is important. So when you see 3 stars, that's usually what I focus. 3 stars. So Europe, they announced the CPI. Oh, I think they announced that already. Yeah, it was before that it was 8.6. People expected 8.2, and now it's come up with 8.5. So this is actually higher than expected. So that's not good. So let's look at here. Jobless claim. So let's focus on this one. Do you think it's a good or do you think it's bad? So for each economic indicator, you have to understand the logic and the findings behind. So initial jobless claims, that is for the US citizens. If they are out of job, then they can go to the Labor Department and say, hey, I'm out of job. Can I get some subsidy, some money from you? And usually, if you are out of job for the first year, you can actually go and ask for money. Yes, people would do that. 失業救濟金 And you see the number, it drops to 190,000. Expected is 195,000. But it drops to $190,000. So it's lower than expected. So you have to think, fewer people going to ask for money. That means everyone is having their job, right? Everyone have a good job right now, so they don't need to ask for money. That means what? The market is actually pretty good. The economy is running pretty good. And if the economy is running pretty good, then what will happen? Interest rate is going to rise faster and stay longer at a higher level. So good news becomes bad news for the stock market. But of course, yesterday, when after they announced this, the market actually flipped back, and it was actually moving up because it dropped too much. So you can have all kinds of explanation. So watch out for the ones with 3 stars, high volatility expected. So you can see how this goes. So this is the real life thing, and you can have access to economic calendar yourself. So I think it's here. Analysis. And what is that? Oh. Tools, economic calendar. So this is how you can see it. So when you go after once you know exactly what's going on with the economy, then you drill down one level more. We call the sector, and then sector is actually even a higher level than industry. So what you probably will heard of the name industry, right? But industry is actually a lower level. We talk about sector. So sector will be at a higher level. So you have 10 sectors or 12 sectors. For industries, we have 40 or 50 industries. So once we have this, and then you see how many industries we have. This is actually just part of it. 2020 ROE, return on equity. You put in $1,000 as shareholders' equity. How much of that 1,000 can turn into a company's profit? So this is how this is what ROE is. And there's another term, ROA, return on asset, and ROE. So you can actually drill down and then try to get a sense of why the industry will have a higher ROE, or why some of them will have a higher ROA or lower ROE. And there's another indicator, but it's a valuation ratio. It's called the PE ratio, price to earnings ratio, and that is the valuation ratio. And in Cantonese, that's CA. The PE ratio by industry global 2020, and you can see how that goes. And of course, you can see some PE ratio actually exceeded 50 times. You can see most likely it's a software related, internet related. It makes sense because for $1 of earnings, the price can trade above 100. When you look at Yahoo back in year 2000, it was trading over like 150 times PE ratio. That was crazy. What about Tesla? Tesla was actually trading a much higher multiple before. Amazon as well. So if you ask, hey, how can I get a PE ratio or whatsoever in a particular index, you can see here. So let's check McDonald's. McDonald's PE 32 times. Even McDonald's is trading at 32 times. So that is quite expensive. So McDonald's, you can consider that as a stable company, consumer stable. It is not a luxury goods. It's a leisure company, but it is still trading at 32 times. So what? And then you ask, so what is the normal PE ratio? S&P 500, which is the US index, on average is 15 times. Anything above 15 will be like sort of overvalued from a long-term perspective. What is the Hong Kong index? Hong Kong stocks are a PE level 10 times, 12 times, much lower. So Hong Kong is always trading at a discount. And then there's industry stock price performance, and you can see like by industry, and then and that is back in 2018. It was not a good year. It was not a good year. And then once you have the concept, then you know this, but by sector and then go below. So what if you want to check, hey, what is the industry classification? I want you guys to remember there are two the two systems that you need to understand. The first one is the internationally recognized standard, GICS. The Global Industry Classification System is managed by MSCI, FARA. So they will have their own view how to classify each company into different sectors or even industry. So let's say Tesla, they will belong to a consumer discretionary. Interesting, right? So it will be something like that. The second system that you may come into some point in your life, that is the CSRC system. CSRC, what the hell is that? CSRC is the one managed by the Chinese securities regulator. CSRC, I can't remember. Some Chinese securities regulation commission or something like that. But it's managed by the Chinese government. They have their own view. They believe that their companies should belong to a certain industry or certain sector. So that's a two system. Will they reconcile? They don't talk to each other. But so if you ask, hey, well, if Tesla is considered automobile company, it may not be considered an automobile company in the view of the Chinese government. So it really depends. Really depends. But there are two systems that you need to you may need to aware of. So don't just remember there's only one system. No, but there are different classification systems. And different hierarchies. So going below healthcare, there will be a biotech and pharmaceuticals and all the way down. So one important thing is to try to see the sensitivity to the business cycle. This is actually what I just said. If you are able to predict the business cycle, how can you make the money out of it? Then you can see if the particular company or particular sector or industry will react first or not react first. And in this case, sensitivity to sales. Remember, in terms of a business cycle, if the economy is bad, no one is willing to spend money. And if no one is willing to spend money, the first thing they cut will be the luxury goods. They'll cut all the travels, all the leisure, entertainment, and all the that kind of expenses. But will they cut your daily essential? Let's say you need to commute by bus. You will not cut it. You will cut the air travel to Thailand, to Korea. Let's say to Macau, to Taiwan. But you will not cut the bus, the commute, the food that you need to eat every single day, right? So this is the difference between a cyclical business and the defensive business. Grocery and jewelry. You can see the major difference. Jewelry, high beta. Grocery, low beta. And in this case, when you are going to see a recession is coming in, which one are you going to buy? Are you going to keep buying Tesla, or are you going to shift? Are you going to shift your money into shifting your money to, let's say, some utility company? Utilities, because everyone has to turn on the TV, right? Or at least turn on your light at night. So those will be quite stable. In this case, you may be able to move faster than your peer than the market. And to be honest with you, 2022, a lot of multi-asset companies, they have switched their equities portfolio into the fixed income portfolio, and then even extract part of a substantial part of the money, the capital, into cash. This is how they position themselves, because they believe the economic cycle It's going to end. Recession is coming. This is how you should do in your life as well. You know something is coming, put everything into cash. So you have to identify if the company is actually a cyclical or a defensive. So first of all, it's using the sales. The second of all is using operating leverage, which means it is about the how much fixed properties, equipment, how much fixed assets. So Tesla will have a much higher fixed asset because they need to they are the manufacturer, right? But what about Tencent? Do you think Tencent will have a big factory? Oh, everything is just software. So they can just fire a lot of people. What about Goldman Sachs, JP Morgan, Citibank? These three guys just announced to cut 10,000 people from their workforce. Do they have any fixed asset? Do they have a high operating leverage? Zero. They have no equipment. They have no machine. They can just fire people. And if the economy comes back, then they can just fire them back. It is like this. It works like this way. So if you see all these big guys firing people, you know they are not stupid people. They are really smart CEO. If they fire 10,000 people this time, they know that it is not going to rehire them in the next year and a half. Recession definitely is coming. So you can see how the news can react to the stock. Financial leverage, very easy. Financial, which means how much debt you have in your balance sheet, in your bank account. So sales, operating leverage, financial leverage. This is how you can differentiate this from the company to the business cycle. So that's the basics. And then in here there are several companies and A and B. And in this case, A and B would have a difference in terms of recessions and also in expansion. So in recession, B may lose a lot, 50 cents. But in expansion, they may gain that 50 cents back because of some fixed costs that they have. So this is the operating leverage. And again, this is the business cycle and sector rotation. One of the investment strategy, major investment strategies that people will deploy. And even myself, I will deploy this as well. When I manage portfolio, I will shift the weights. If I see the bad time is coming, then I will shift the weight from one sector to another sector. So that is one of the investment strategy. Shifting out from the technology stock into the defensive sectors. So this is, if you ask, hey, I probably will not be able to give you any number, but I will give you this particular chart. Sector rotation, it works every single time. I've never seen it. It didn't work, but it works every single time. So, of course, I'm not going to ask you this in a quiz or in anything. But this is actually for your own good. If you want to invest in your real life, and you know recession is coming in, what are you going to do? Are you going to keep investing in the technology stock? You got to think about that. Let me just wrap this up really quick. So, once you have the business cycle, and then there is an industry cycle. Industry cycle is the industry itself. And usually it will going from the very beginning time and then all the way up, and then at the end it will be going down in decline. Introduction, growth, maturity, and decline. So if I ask, what is the AI situation right now? Of course, it is introduction. Everyone is jumping into it. What about 4G telecom? It is actually in decline business. 4G probably is going to retire very soon. So if you are only selling a 4G business, then you need to think about your exit way. Traditional oil company is also the same thing in decline business, because if more and more new alternatives energy is coming up, then no one is using the traditional gas. So that will be quite worrisome. And this is why Saudi is trying to sell more shares here in Hong Kong, because they just want to find more stupid people to buy their retiring oil. The oil price may not be able to sustain at $80, $90. Going forward in 30 years, oil may become like $20. In this case, they want to sell as much as possible at this price, right? So this is how you can see it. And again, industry life cycle, it is different from the business cycle. So when you do the industry analysis, then one thing you need to think of is I'm sure you heard that you learned that from marketing, the SWOT analysis, the strength, weakness, opportunities, and threat. Same thing here when you study, after you study the macroeconomics, then going after the industry, you have to go through all these parts. SWOT analysis, quantify forces, understand the stakeholders, all that kind of things. Once you finish all this, you understand the business structure, how the business model works, then you can move on to the next step, which is the company valuation. And the company valuation, equity valuation, is the very thing that you need to learn. Pretty much like the juice of this particular course. I'm going to stop here. Let's take a 5-minute break, and let's be back at 10:10. All right. Thank you. So let's get back here, and I will use a really fast pace to wrap up this this thing. So the one last conclusion about this macro, because this is actually more, I think it's more useful to you, and you will heard about this more often than the next two PowerPoint slides. And because for the next two PowerPoint slides, those are more technical topics, and for those who are accounting major, you probably will understand this easier. And from everything that we talked about in the past, let's say 1.5 lectures, that's top-down approach. So when people ask what kind of analysis you do the first top-down approach, find which country you want to invest, find which sector you want to invest, and then you do the second part, the bottom up. So this is top down, and now we do the bottom up. So at the lowest level, that's the company. There are a few things I want to say about this this level. We have the top, the middle, and the bottom. So top, the macro, the industry, and the bottom. So if I ask you, what is your best investment strategies if you want to choose a fundamental analysis? The first one is you pick the right country that is growing. If I said, are you going to invest in Philippines? Probably not. The country is not growing. They don't have. I didn't pick up much, but let's see if the GDP is not growing. Industry is not growing. Basically, the government is just a corrupted government, and there's no strong central bank to work for the people. Then in this case, why do you still want to invest in Philippines? Trust me, I've had questions asked 7 years. That was 8 years ago. The China Reserve Bank, the China Reserve, they want me to invest in Philippines. I said, first of all, there's a problem just doing the pure trading. We cannot execute any order without passing to an agent, which you need to pay a huge transaction fees to the agent in order to get the shares. And second, every single thing is insider trading information. You don't have access to the market, you got screwed, you got played. So that's not good. If you know the country is not good, then why do you want to invest in that country? And the second thing you have to invest is, if the industry is a dying business, have you seen any video tape before, like the hardcore video tape? Concrete, the physical one? No, you haven't, right? Let's say if there is a company manufacturing this video tape cassette, are you going to invest in this company? No. If the industry is dead, no one is going to use the videotape anymore. It's gone. Then in this case, why do you still want to keep buying this company? Are you going to buy Kodak? Do you know what Kodak is? It's a film where you take a picture, not using a cell phone, but the actual camera taking the picture. You need to have a Kodak film to do that. Are you going to buy that company? No, it's dead. No one is using that to do that. So in this case, you want to buy an industry that is actually rising. Which industry is rising? Well, you can say it's AI. You can say it's new energy. All these things will be rising industries. You buy any one of them, perhaps you can follow the ride. That is the key. Why you need to differentiate this? Because you need to make sure you understand the industry. If the industry itself is a dying business, then you need to find some extra value in it. Kodak. You know how many patents they have in this company? How many copyrights? Over 500 copyrights in this Kodak company. You buy the company is not because of the film itself. You buy the company is because of the value of the patent. That is the juice. So you need to understand what is the value behind every single investment decision, but not blindly to buy something. Of course, if you don't have that resources to find out, to take in the information, I told you in the EMH, get the basket out of it. Buy the entire sector, buy the entire market. Sit it and just wait for the return, and that's it. That's good. That is actually one of the strategies. I was actually talking to your dean the other day. Actually, it was last night. It was last night. He was actually asking me, hey, there was one portfolio manager, actually a group of portfolio manager trying to do an update view for the school, because the school has a lot of money. I'm not saying the business school, but the entire school of Metropolitan University has a pool of money, and the money has to be invested. The portfolio managers give them an update, quality update, and they said they invest more than 40% into SPX ETF. Do you know what his reaction was? It was like, I pay you all the heavy fees to hire you to help me to manage the money, and you are saying you're buying the SPX 500 ETFs? That was ridiculous. So in this case, you can see like what kind of edge you have in terms of investing. We hire some professional like them, then they have to spend their resources and dig deep into each company, each sector, and try to extract the value from it. So this is how how you guys should think about industry and also macro industry and sector, and then applying the EMH. And the bottom of it is the company. So when you look at the company, I know that not many of you understand what a financial statement is. But this is very, very important because this is the health report that will provide to you half a year or on a quarterly basis how good the company is, how bad the company is. Of course, the one who gave you the report is the company itself, verified by a third party, which is called an auditor. But can they manipulate the number? Yes, of course they can manipulate the number. They can play around with the number. Then you need to be a detective sense. You have a more detective sense, and to see if those numbers are reasonable. Why do they want to use this financial statement? Because they are obligated to do that. It's mandatory. They need to tell the shareholders how they perform. You use the financial statement to evaluate the company and to evaluate, compare company to company and company itself. There are actually three major types of financial statement. And let me give you an example. So BMW. BMW, Germany. We can still look at the Germany's, they are all the same. Doesn't matter which country, which company. Germany, Australia, Canada, China, doesn't matter. Everyone will have the similar structure. You have the total revenues, right? How much sales they make. And then you have cost of goods sold, the cost of the particular car. And then you have the gross profit, which is the gross margin. You can see it is actually not too attractive. For $100, they make like $20. So $100 sale. After the material cost, they can only make $20. And subtract all the operating expenses and things like that. Then at the end, they can only get like $12. So for $100, they get $12. So that's 111, that's got $12. That's about 10%. So think about this, BMW, they can only make 10% for every single car they sell. Is that a lot? Do you think this is a lot? Let's check it out. 10 cents. So let's say this TTM, total 12 months. So the last 12 months. $500. And how much they make? $176. Which means that it is close to 25%. Or at least more than 20%, right? So this is actually much better than BMW. Do you have something even more than that? $29. They make $9. 1/3 of it, close to 1/3. Is that good? Oh yes, of course it's good. So there is actually one way you can sort out, okay, well, should I buy this company or not, or buy the other companies?
So how do you know the company might higher?
How do you know which company will have a higher or lower? Well, you have to compare. Well, of course, so you have to drag all the companies and then try to analyze each one of them. And then perhaps you can see if the company is actually doing a better job from last year and this year. So let's say for this guy, it was last 12 months is $9 out of 29. But this it was last year, it was only 4 out of 22. Less than 1 out of 13. Right? So you can see it's actually improving. And this one is actually improving a lot. So in this case, you can see how everything goes, and if you get into some other let's say companies or comparing companies within the same industry, so this is how you should do all the analysis, and I'm going to show that to you later on. So that's the first statement. The second statement is we call the balance sheet. So income statement. Remember this. income statement is always from one time to another time. It is always, let's say, from January 1st to December 31st. So within a year, how much they make. But for balance sheet, it's different. Balance sheet is a photo taking. It is the money in your bank account. Can your money in your bank account different from day one to day two? Yes, because it accumulates interest, right? So all we can do is we take a snapshot. Balance sheet is always as of one particular time. The balance for 新特能源 新特能源 is 58 let's say $58 total asset. Liabilities 34, total equity will be 23. So these two, A equals L plus E. Asset equals liabilities plus equities. That's the formula for finance. So if you ask physics, they have F equals MA, E equals MC squared. For us, it's very simple. Just A equals B plus C. We have A equals L plus E. And if you click here, and then it will break down to currents, non-currents, and then liabilities. So what happened? What is balance sheet here? Let's take a step back. Balance sheet on the left-hand side, that's total asset. On the right-hand side, that is the capital you borrow from the market. So on the capital you borrow from the market, there are two types. One is the bank. Let's say you borrow from the bank, or you borrow through the bonds, the fixed income market, your debts. The second one is your own pocket, plus any partners, any shareholders that will like your company. And let's say you have 1,000 people like your company at $10, then you can get $10,000. That's the equity. When you have these money, of course, you're going to buy the equipment. You're not going to put everything into cash, right? You can do that. When you start your business day one, you collect the cash from bank, you collect the cash from your parents and your shareholders. Let's say aggregate is $100, then you put that in the bank account as cash. But in day two, you will buy the equipment. Do you think the cash borrowed from the bank will let you to just put in the cash? No, of course they want your money to grow. But do you think your shareholders, when you put in your money, do you think you just want the money in the cash in the bank account? No, of course not. You want to grow the money, so you need to exercise. You need to invest. You need to run the business. In this case, your asset side will start to have PPE, property, plant, and equipment. Your asset side will start to have cash, accounts receivables, getting the cash from the customers. And at the same time, your debt side will start to accumulate current liabilities, paying to the suppliers, any warranty expenses will all be booked in the liability side. So in this case, when you run the company, your L plus E will become more and more sophisticated. And let's say your total liabilities will have current liabilities, the current one, long-term one, and then you have the debt side, the borrowing from the debt market. And then you have the equity. So I hope you understand what the balance sheet is. The hardest part is the cash flow statement. And let me tell you this. In the market, at least in the Hong Kong market, and a lot of the people in China market, financial market, they may understand how to evaluate an income statement. They may know how to take a look at the balance sheet, but I can guarantee you maybe less than 10% or even 5% of the people will know how to read a cash flow statement, because they don't even know how to construct a cash flow statement. But the most important thing is the cash flow statement. If you are not able to balance your cash flow statement, then will be extremely hard to actually evaluate the business. Because in this cash flow statement, in a nutshell, I'm not going to show you how to balance that, but in fact, in your 385 worksheet, example, I have that financial model with you, a balanced cash flow statement. Next year, when you are taking 328 10-hour credit course called entrepreneurship, then in your assignment number 2, you will encounter this statement. So let me give you a hint 1 year early, because I remember last time I posted a video up and it was actually over 700 times views. But just to explain to you how to calculate how to construct a financial statement. So listen to this carefully. You have the sample here, and you can apply that in your 328 in your next year's course. So remember, you will get my email later on, maybe after like October, November this year. Then you probably will have all the questions. Anyway, cash flow statement, 3 major parts here. Is cash flow statement a separate, like a separate statement? No, it is not. Cash flow statement is a product, is a byproduct when you smash the income statement and balance sheet together. All you need is 2 years of balance sheet, 1 year of income statement. With these 3 reports, I can smash out a cash flow statement. Doesn't matter which company it is. I can do that. So this is the key about cash flow statement, because it is monitoring where you spend your cash in the company. And they put it into 3 categories. The first one is how you do in your operation. So operating cash flow. How you use your money to generate your income, your profit. The operating angle. The second angle, second point of view, is how you use your money to invest in the machines that I was just talking about. When you run a business, you definitely need machines, right? In this case, in a Tesla or in any manufacturing company, you will see the invested cash flow getting higher and higher. And then the last one is financing cash flow. Then there is actually some kind of magical relationship. Think about this. If you are not able to generate sufficient operating cash flow, how can you buy machines? So let's say if the first part is negative, let's say right here, the first one, operating cash flow, is negative. How can you invest? How can you have a negative investing cash flow? Sure, you can have that. Then you need to borrow. That's why you see a positive numbers here, financing cash flow. You borrow from what? From the bank, from the stock, from the shareholders. But then when you add these 3 up, your cash position should be a negative number, right? I mean, because when you add up the OCF and ICF, that's a $6 million. But you will only be able to raise a 4.6. Where is that the 1.6 1.4 come from? Cash reduction. So assume you have cash in your account, then you're reducing cash. So in this case, ending cash position compared to 2018, there will be a cash reduction. This is very, very important, because a lot of analysts out there, they can project a huge, very, very nice income statement. The operating cash flow is so beautiful that actually you believe the story. But the problem is they forgot to balance the balance sheet. They didn't even put any of the projection in the balance sheet. In this case, the investing and also the financing will go off the picture. And that is a problem. Where did you get the cash? A good example, Hai Dai Lo. They have a huge growth in the stores. But then The top revenues cannot support the second and the third line. Cannot support the investing. Well, they have a huge investing growth there, so huge negative. But the top line cannot support, which is the operating cash flow. How can you do that? Then they are not going to, if they said they don't want to borrow from the banks. How can they do? They're going to suffer more. So they are burning cash. So you will see a lot of fast growth company. They keep burning cash and burning cash and burning cash, and up to a certain point when your business cannot be sustained by that high growth, the revenues cannot pick up, then there will be a problem. This is how you read the financial statement, especially a cash flow statement. These three parts is most important. How the company generate the cash, how the company get the return. Can they invest appropriately, properly? ICF. If they don't have money, can they raise the capital? FCF. So this OCF, ICF, and FCF is very, very important. Very, very important, very critical. So if you see a really huge negative number here, let's say this -13 here, you believe that, hey, this is actually not good. The company is investing too much. My point is, hey, this is actually good. I invest in this company. I hope the company will invest, right? And this is how they invest. So I think this is actually good. If we switch to 10 cents, let's see how it goes. You see, they are still running something like this. This will give you a different picture. They will still invest a lot. They won't stop. They will still invest. And if they don't have money, then they will raise the debts. They will raise the equity. They will do something like this. So you can see that there is a big difference. And this will be different from what you see in the income statement, because in the income statement, it seems like they are making a lot of money, like what, 20%. But in here, you see they are actually just barely making through the investment. So this is a big difference between the like different usage of financial statement. I'm not going to talk about the economics earnings and account earnings, but I think I gave you sufficient sample so you can look at. Target is actually one of the US. Treat that as like a welcome or park and shop in Hong Kong. Target is similar but a much bigger in size, and you can check out the financial statement for Target. And again, I'll show that to you with the financial sample. So this is the income statement. How much money the company made within a year. This is 2018, and you can see the net sales, cost of goods sold, SG&A, and then operating income, which I call the EBIT, and then interest expense and all the way down, and net income. So every company, doesn't matter, it's a Target, 10 cents, BMW, they always will be listed in this kind of format. This is the standardized format. And then in terms of the balance sheet, that was the one I was talking about, the asset, and also L plus E on the other side. And so if with all the income statements with you, the three income statements, the cash flow statement itself actually is not that. Once you know how to analyze that cash flow statement, then not much ratio is actually getting from the cash flow statement. But then the income statement and also the balance sheet, you can have more than like 50 different ratios that you can assess the company's health, and also the company's not company's value, but company's situation. let's say, operating situation, the leverage situation, the credit situation, and so on and so forth. So now we are introducing you the ratios. And before we do that, all these ratios actually are used by not just the shareholders, but also by the management. When the manager, let's say the CEO, they think about like what kind of capital they need to get into, right? Debt capital, equity capital. This is the part that I just explained to you, L plus E. So L will be the debt, E will be the equity. Where did you get the money from? You borrow from the bank, or you borrow from the parents, or you borrow from the shareholder? That's L plus E. And as a CFO, Chief Financial Officer, you need to think about where you get the money. You as a CFO, you need to get or secure the source of money as low cost as possible. So when I was actually working in the firm right now, the CFO is actually sitting next to me in another room, and he was always talking to the banks and see if there is any that he can actually raise to borrow at, let's say, 3%, and then if we're able to turn that 3% of loan into, let's say, 10% or 50% of the profit, then we're actually capturing that 7% of that loan, right? If we are borrowing $100 million, then that will be a substantial amount, $7 million of spread that we can make, right? This is how the CFO and the CEO thinks. Then in this case, it's a good borrowing, right? $100 million, pay a 3% debt, 3% cost of debt, and then we make a return of let's say 12%. We collect 9% out of that borrowing. $100 million for 9%, that's $9 million. Sufficient to pay a small team in the office. More than sufficient. But this is the financing decision and also the investment decision. But I smash everything together. So in finance, you have to think of a new way to make money. And this is how you cooperate with other teams to make money. To borrow and then to invest. So financing is and then the investment decision. And then of course, for me, we are like a financial service firm, and everything will be just a labor base, not the equipment base. But then if you are running a Tesla, then you have to think about, hey, how much you can make from the asset, from the equity, from the capital. So all these decisions will be supported by the financial ratio. And this is where it all comes from. And by the way, these financial ratios are either from the income statement or from the balance sheet. So it is not something that we create. We use the two statements, not even cash flow statement. Cash flow statement is just for the overview. But for the income statement and the balance sheet, for all these items, then you can drill down to like all these ratios. And let me tell you this, I was working on standardizing all these the list companies in Hong Kong, and for the industrial type, so let's say any particular company listed in Hong Kong, I have 185 different accounts, different fields from income statement and balance sheet, and I can cover the entire Hong Kong, all the listed stocks in Hong Kong. 185 fields, and within these 185 fields, I'm able to calculate all these ratios. So I'm able to assess, or maybe I'm able to assess, to evaluate every single company in Hong Kong. What is the health status? What is the let's say the ROA, ROE, and ROC? And this is actually can be done. I can compare companies to companies, or even the company itself in a type series. Okay, so far, I don't need you to remember the formula right now, but I want you to understand that there are some ratios that it is actually very important that you need to be aware of. ROA, ROE are the ones people are mentioned, and I hope you understand how to calculate that. And this is very likely it will be the quiz. It will be the ICA 2. So make sure you know this. So let's say if I provide you a net income and I provide you a shareholders equity And then I will ask you, what is the return on equity? Very simple. Of course, I'm not going to give you just specific number. I'll give you a balance sheet, an income statement, and then you need to pull out what is the ROE reading from that financial statement. So that will be it. So it will be very easy, and there will be more math going forward. If you guys don't like writing, right? And more complicated formula is the financial leverage. So when I have the ROE, return on equity, net income divided by shareholders' equity. So how much you put in, chip in from your wallet, from your friends, from your partners, that's the total shares equity. And then how much money you can generate from that business. That's net income divided by shareholders' equity, ROE. But if we look at ROE, and if we expand that ROE formula, and we can find out that actually that can be switched to ROA, and then with the debt and equity capital structure. This is what we talked about, debt to equity structure. That was actually probably in the first lecture. How much or where you get your financial, get your capital, get your money from to run the business. And of course, like this is the leverage ratio. If we break it down to the details, and I'm not going to go into details with you what's going on. But one thing I want you to be aware of is for this particular slide. Try to work out the number ROE here yourself, because I'm going to give you just a heads up. Evergrande, Xu Jiaying, the CEO, why is he gone missing? Why is not gone missing? But you know, he got locked up is somewhere in China. Because the problem for him is he has so much debt for himself. Well, you know that debt is not good, but it is actually good for him, but bad for the citizens, bad for the economy. Why is it like that? Because he leveraged up himself so much that the debt itself can compare to a country. So what happened was, think about the math, the simple math that I just showed you. Let's say you borrow 100 million from the bank. You pay 3% interest, and then you get 12% return. At the end, I'm getting 9%, right? Very simple math. He has founded the company, Evergrande, in the past, let's say 15, 20 years. Let's say if he is not using 100 million, first assumption, if he is using $100 billion, and the second assumption is, let's say the 12% return, he can get 9%, right? But if he is the largest shareholders of the company, do you think how much he can get? Of course, like he will get a lot of return. The net 9%, he may get 40% out of that 9%. So let's say he can get $3.6 million, right? If he is able to raise $100 billion of money and invest in the real estate project and keep pushing the real estate market as high as possible, every year he is making $3.6 billion. And calculate that $3.6 billion times 15 years. He can be the world's wealthiest man alive by poverty online. Easy. So whatever he borrow, he can borrow. He put that in the real estate market and he make a fortune for himself. Well, the problem is the major assumption is if the real estate market keeps pushing to the higher level, and you know that it wasn't like that in the last couple of years. It crushed. No one's willing to buy the real estate, and in that case, he suffered. Well, he said, "No, I'm not going to suffer." Well, it's the shareholders that suffer with me. I keep my wealth because I locked that $3.6 million in my pocket already. That is a problem. That is a problem with the too big to fail. We cannot kill him right away. because he's still useful, because he has to be used to unwind all the asset. But for sure, his entire portion right now will wind down to zero because he cannot pay down his debt. That's one thing for sure. So this is important because why financial leverage is good, because from this case, you can see in a good year, you will have a higher ROE in this case, 11.8% than the no debt situation. So I want you to understand this slide, try to calculate that yourself at home and understand why leverage is actually good. But of course, when you exceed certain point, leverage will be bad, will be really, really bad. So there are some examples here. To show you how you can actually calculate the I'm sorry, this one is ROE. And also they show you how to what is BMW, leverage ratio, and also ROA and ROE. Oh, it's on the balance sheet. It's right. It's right there. So someone asked, how can you find the RO? So let's say here, give you an example. So if you go to Yahoo Finance, they have. When you go to Yahoo Finance, they have everything here. So they have the PE, ROA, and ROE. So you have that. And of course, where is the equities portion? Then you go back to financials, and then you go back to the balance sheet, and then there will be stockholders' equities here. So use this number as a base, and then net income divided by that, and then you will be able to get that. So I know it's running out of time, and we will continue this session in the next lecture. How about that? EVA is something actually far more complicated. Let's talk about this the next slide. Right, so slide 16. All right, let's wrap up. And any other question? We'll continue next week. All right. It's done. Then everyone has a good weekend, and let's enjoy the 2 sessions and see what they're going to announce next week.